If you're self-employed, or maybe you run a small corporation, you know that tax compliance can feel like, well, like hitting a fork in the road.
It really can.
And your first job is just figuring out which path you're supposed to take, and then which one is actually better for your wallet.
Right.
So today's deep dive is all about those choices, those specific thresholds that define everything. We're going to be pitting gross receipts against net income and these flat rates against the progressive ones.
And that's really our mission today. We want to give you a shortcut to understanding these core differences. We're unpacking what gross sales or gross receipts really means for, an individual business owner.
Versus net taxable income for a corporation.
Exactly. And we need to get really clear on when that simple 8% flat rate is an option and when you're sort of forced into the more complex world of 20, 25, or even up to 35%.
Okay, and we should probably mention up front, the source material we're using today talks about pesos and a specific tax authority. But the principles here, comparing gross versus net, trading deductions for simplicity, that's universal. So let's focus on the mechanics. Before we even get to the percentages, let's nail down these two terms for an individual.
Yeah, good idea. So when we're talking about an individual, say a small shop owner, the total money they get from selling physical goods over a year, that's called gross sales.
Okay.
But if you provide a service, you're an architect, a developer, a doctor collecting fees, that total amount you bring in is called a gross receipt.
So really, both terms just mean the entire pot of money that walked in the door.
That's it.
Before you've paid your rent, your staff, the electricity bill, it's just that top line annual revenue.
And that one number, that total, is the absolute starting point for any self-employed person. It determines whether you get a choice at all.
Okay, let's get into that. This is our first theme, the self-employed person. The whole decision, right from the start, it hinges on this one critical number, which in our source is 3 million pesos.
If your gross sales or gross receipts go over that 3 million mark, the choice is, well, it's made for you.
It's gone.
It's gone.
Wow.
You are automatically put into the regular tax system.
No debate, no simplification. You're in the progressive system, period. But if you're at 3 million or below, then you have this really critical and often kind of tough choice to make between two very different paths.
Mm-hmm.
So let's start with option A, the 8% flat rate. I think this is what it sounds most appealing just because it seems so easy.
It's designed for simplicity, absolutely. The calculation is incredibly straightforward. You just take your total gross sales or receipts, and right away, the tax authority lets you deduct an initial exempted amount of 250,000 pesos.
Okay, so that's just off the top.
Off the top. The amount that's left over is your taxable base. You multiply that by 8%, and that's your tax. Done.
Simple math. So if you made 2.5 million, you subtract 250,000, that leaves 2.25 million. You pay 8% on that. But what makes it so attractive? I mean, besides the easy calculation, what are you buying with that 8%?
You are buying compliance simplification. That's the huge benefit. When you pick the 8% rate, you're exempt from two separate tax obligations. You won't pay a separate income tax, and you won't have to pay separate business taxes.
Oh, wow. So one rate covers everything.
It covers everything. It dramatically cuts down on all the monthly filings and paperwork.
That sounds like a really powerful reason, especially for, a solo operator just trying to keep things lean.
Yeah.
But you said there's a severe trade-off. So if simplicity is the upside, what's the big downside?
The downside is that you basically lose financial reality, at least in the eyes of the tax code. The trade-off is this. Your business expenses are strictly non-deductible.
Not at all.
Not at all. Beyond that initial 250,000, they don't care if you spent 100 pesos or 2 million pesos to run your business. You're taxed on the gross amount minus that $250,000.
A severe trade-off. Isn't the simplicity worth it? I mean, most small businesses don't have huge overhead, right?
And that is the exact trap. I mean, if you have very few expenses, maybe you're a digital consultant working from home, the 8% is fantastic. But the second your expenses become substantial, that 8% deal goes from being convenient to financially painful. It's a real gamble on your business model.
And that pushes us right into option B, the regular income tax. So if you say no to the 8% rate, you fall into this progressive structure.
That's right. And this involves much higher headline rates. The schedule goes from 15% all the way up to 35%. It climbs in steps, 15, 20, 25, 30, and 35%.
So why on earth would any sane person choose a rate that could hit 35% when 8% is sitting right there? I mean, that just feels wrong.
Because this is where the reality of running a business actually matters. The huge benefit of the regular rate is that all your ordinary and necessary expenses, They're deductible.
Oh.
So if you have high overhead, you run a clinic, you pay salaries, you buy a lot of equipment, you can document all of those costs and use them to drastically shrink the number that 35% is applied to.
So the core difference isn't the rate itself, it's the base that the rate hits. With the regular rate, the percentage is higher, but the taxable income is
Much, much smaller.
Exactly. Now, this option must have a trade-off too.
It does. If you choose the regular rate and deduct your expenses, you are now back on the hook for paying business taxes, which you were exempt from with the 8% option. So you gain deductions, but you also regain that compliance burden.
Okay, this is where it gets really strategic. Let's run the numbers with the example from our source, because this really proves that the lower rate isn't always your friend.
Okay, let's do it. Let's say you're an independent lawyer. Your gross receipt is 2.5 million pesos, so you're under the 3 million threshold. You have the choice.
Right.
But let's also say your documented expenses, your rent, paralegal salary, office supplies, are really high. Let's say they total 2.4 million pesos.
Okay, so under option A, the 8% flat rate, my 2.4 million in expenses, they're just ignored.
Completely ignored.
I take my 2.5 million gross, deduct the 250,000 exemption, which leaves a base of 2.25 million. I pay 8% on that. That's 180,000 pesos in tax. That's a massive bill when my actual profit was only 100,000.
Now look at option B, the regular rate. You take your 2.5 million gross and you deduct your 2.4 million in real expenses. What's left is your net taxable income, just 100,000 pesos.
And wait, since that 100,000 is below the 250,000 income tax exemption threshold, I pay zero income tax.
Absolutely zero income tax. Now, you still have to pay business taxes, yes, but on only 100,000 of net income, that business tax is going to be way, way less than the 180,000 you'd have paid under that simple 8% rate.
This is a huge trap for anyone not paying attention. It just proves that for the self-employed, it's a pure math problem. You have to guess accurately if your expenses will be high enough to make the extra paperwork of the regular rate worth it.
Exactly. The lesson is convenience can cost you a lot of money if you have high overhead. That 8% rate is a gift for high margin, low expense work, but it's a disaster for high volume, high cost businesses.
Okay, that wraps up the individual's choice. Now we can move into theme 2, the world of corporate taxes. And this is where that whole framework of choice just kind of vanishes, and the key metric shifts from gross revenue to net income.
It's fascinating, right? The immediate difference. Corporations are automatically regular taxpayers from day one. Even if a corporation is brand new and its gross income is tiny less than 3 million or even zero, it is not allowed to use the 8% option.
So no shortcut for them.
No shortcut. Corporations live entirely in the world of net taxable income and these specific corporate rates.
They jump right into this landscape with basically two options, 20% or 25%. So who gets stuck with the higher 25% rate automatically?
Well, the 25% rate is the default. It's for any corporation that doesn't meet the very strict criteria for the lower rate. And here's a huge dividing line. This explicitly includes all foreign corporations.
All of them.
All of them. It doesn't matter how small or new a foreign entity is, it has to use the 25% rate. The 20% rate is reserved only for domestic companies that meet some very specific rules.
That feels like an automatic penalty, just for not being a domestic company. Why would they do that? Just hit them with an extra 5 percentage points right out of the gate.
It's usually about jurisdiction and regulatory control. Domestic corporations are fully under the watch of local agencies, so their books are easier to audit. The lower rate is basically an economic incentive to encourage local investment while keeping the standard rate for everyone else.
That brings up the big question for domestic companies then. What does a corporation have to do to get that sweet 20% rate? How do you officially define small in the tax code?
It's not a vague idea. It's 3 very specific cumulative criteria, and you have to meet all 3. If you fail even one, you're paying 25%.
Okay, lay them out for us. Slowly.
First, and this one's obvious, the entity has to be a domestic corporation. That's the gateway.
Right.
Second, the financial performance test. The net taxable income, and remember, we're talking net income here after all your deductions, has to be no more than 5 million pesos.
Wait, 5 million in net profit? That's not a huge cap. A successful medium-sized business could easily clear that. So if they make 5.1 million in profit, they lose 5 percentage points on their tax rate. That feels like a massive penalty for being just a little too successful.
It is incredibly strict, and it forces a lot of strategic planning. That threshold is how the authority defines a small and medium enterprise, an SME, that deserves tax relief.
Yeah.
As soon as you cross that line, you're treated like a big corporation, no matter how many employees you have.
Okay, so domestic net income under $5 million. What's the third piece?
The third one deals with assets, and this catches a lot of companies by surprise. The total peso value of all property owned by the corporate, everything, buildings, cars, computers, machinery, it all has to be no more than 100 million pesos.
So you could be domestic, have your profit under the cap, but if you own 101 million in assets, maybe you just bought one expensive machine, you're disqualified and you're back at 25%. So small is very sensitive to your physical assets.
Precisely. And there's an incredibly fine point within that 100 million cap that everyone needs to remember. This is where the real devil in the details is.
Let's connect the dots here. What's the specific rule about land value?
The rule says that the value of the land where the business is actually situated is specifically excluded from that 100 million peso limit. This is a critical exception.
Oh, that makes total sense. Otherwise, any business in a prime city location would instantly fail the test just by owning the land their office is on.
Right. It gives them some breathing room for their main operating site. However, and this is where it cuts back, any other land the corporation owns, say for investment or for future expansion or just a plot somewhere far away,
That gets included.
that value must be included in the 100 million limit.
Wow. So if a domestic company has 99 million in non-land assets, but they also own a little unused plot of land worth 2 million, they jump to 101 million, fail the test, and lose their lower tax rate. That is an extremely specific rule. It really forces companies to look hard at their balance sheet.
It certainly does. That 20% rate is great, but it is highly conditional. If you want it, you have to manage your net income and your non-operating assets very, very carefully.
So we've really covered two completely different worlds today. For the self-employed, we've got a choice framework based on gross receipts and expense levels. And we've seen how high expenses can actually make the lower rate a dangerous option. And then for corporations, there's no choice at all. They're just judged by this complex three-part test based on their status, their net income, and their total assets.
Yeah, the takeaway for you listening is that complexity is just part of the game, but it has a structure. For the self-employed, the decision is financial. How do I best use my deductions? For corporation, it's regulatory. Can I squeeze my company inside these three narrow boxes?
And before we wrap up, let's touch on that statistic from our sources that suggests where the real risk is.
This is a fascinating bit of data. It showed that over the last 15 years, a staggering 97% of all cases decided by the highest court in this jurisdiction were about business taxes.
Business taxes.
Yeah.
Like what?
Things like value-added tax variety percentage taxes, excise taxes, not income tax rates.
97%. So that suggests that while we all agonize over picking 8% or 20%, the real legal danger, the real regulatory scrutiny, is actually on things like VAT.
It really raises the question, why is all the litigation there? Income tax, for smaller businesses especially, is pretty straightforward once you know your bracket. But VAT and percentage taxes involve these incredibly complex rules about documentation, input and output taxes, exemptions.
Right, proving every single transaction.
Exactly. Proving that your input-output mechanism is sound, that every receipt is perfect. That seems to be where the legal disputes happen. It's the headache of the daily grind, not the final rate you pay.
And the tax authorities probably find it much easier to challenge a stack of receipts than to argue about whether a company really made 5.1 million instead of 4.9. The risk is in the day-to-day compliance.
That's it. It's in the fidelity of your compliance.
That is the ultimate deeper dive. Getting your income tax rate right is maybe only half the battle. The true legal risk, for many, lies in those business taxes. That is definitely something for you to think about. Thanks for helping us navigate all of this today.
My pleasure. Thank you.